Hello and welcome to BloombergQuint. We have a review from the Monetary Policy Committee. No change in interest rates as was widely anticipated, but a lot more to discuss along with the RBI's forecast of a 9.5% contraction in real GDP this year, plus their sense that they would look through the current inflation scenario. They provided inflation forecasts as well. Host of regulatory measures, liquidity measures thrown in. I will detail them as we go along, but let me welcome in our panel because we've got a host of experts to help us drill through all of that on today's conversation. Saugata, Bhattacharya, Chief Economist at Axis Bank, will help us give the big picture as always. We're grateful to have him here again. We've got Arvind, Chari with us, Suvodeep, Rakshit is with us, and Jaideep, Iyer of RBI Bank joining us as well. Thank you all so much. Really, really kind of you to take the time. Saugata, to you first, as always, to give us the big picture. No change in rates, but I think we now have a little bit more clarity on their thinking. They are prepared for about 9.5% contraction in real GDP. They're prepared for at least 2 quarters of high inflation, but they've said they're going to look through that. What do you make of their broad sort of macro picture they've drawn up?
So quite obviously, I mean, it's very nice. I mean, to have actually got one growth estimate. I mean, whatever the range, whatever the downside risks, etc. So that helps guide any future policy actions that might actually be needed or might happen. So that's good. Even inflation. If not the numbers, I mean, we have a clearer sense of direction in where we are going. So my guess is, my own sense is, I don't see any further scope for any repo rate cuts because, I mean, given the inflation prints that the MPC will also see in the December meeting, they will also be forced to pause there. And after that, there's really no point in cutting the repo rate. But this policy, more than the others, I mean, I think in a very tacit, implicit signal of growth concerns, and he's repeated that time, the governor repeated that time after again. I think the amount of additional measures, the implicit stimulus there is in the policy, I mean, they are nearing ECB levels now. I think I'm not going to get into this, but I'm sure you're asking. But it's a very, very supportive policy.
Actually, tell me, Saugata, if I can stay with you, what did you see as the most supportive? The sort of on-tap LTRO, the very conciliatory statements that they made towards the bond markets, the first time OMOs of state bonds, some easing on the regulatory side, particularly on home loans. Those are what have I missed?
No, so that's it. The one thing that you missed was the moral suasion statement. You remember, what was it that we expect markets to bear with us, or what was the thing? Market participants need to take a broader time perspective and display bidding behavior. That's the moral suasion part. That, hey guys, I mean, we are with you, we are supporting you, but you also need to provide a reciprocal view. So I think that was another statement. Besides which, I mean, the whole host of things that you mentioned, particularly the SDL bit, OMOs and SDLs, which is a path-breaking thing for the RBI. All the others are extensions of the various steps that they have taken, but the SDL statement is definitely something new. And besides the very, very dovish guidance, I mean, this is something that we had expected.
All right. I'll get into the STL thing in a minute, but Suvodeep, over to you for your macro assessment and whether it more or less matches. I think, there's no need to quibble about their forecast. Nobody can point a finger at them and say that, look, they are underplaying this growth problem. Fairly in line with what everybody has said, right? People are in the range of 8 to about 11, 12%. They are somewhere in the middle at minus 9.5. And inflation too matches with what the market expects.
Yeah, broadly, I think this policy, the way they have, kind of put out the liquidity part as well as the policy part, I think it's something that what the market was kind of, or if not expecting, should be expecting. The forecast bit is something welcome because we have missed it out on the last couple of policies. And I think the forecasts are pretty much in line with what the market expectation is. So I don't think there is anything that the market will want to say that the RBI did not really give the numbers, or the numbers are not believable or anything like that. I think that's perfectly fine.
And you too, Suvodeep, would see no scope for any more interest rate cuts while sort of easing continues from the liquidity side?
I think, see, the December one is something that we knew even in the August policy that the December one is not coming. But from a February perspective, we'll have the budget, we'll have the inflation probably coming down closer to 4%. I mean, we say 4%, but it will possibly be around 4.5% odd. The point is what happens to growth by then, because what we see of growth right now is a combination of, let's say, a pent up demand, a festive demand, and a normalization of demand. Now, how much of this continues into the third and the fourth quarter will kind of indicate whether there is a necessity for policy rate to be lowered, and whether policy rate should be lowered, and whether fiscal policy should be the driving force. So I think there are lots of ifs and buts till we reach February. So we'll see when we reach there.
Let's get into the market side of things. That's where I guess all the excitement is. And last I checked, yields were down at least about 7 basis points. Now you're 594. Arvind, come in. Lots of sort of talking to the market, trying to calm the market after we've seen some devolvements of the 10-year. I think they're sending a message that, look, we intend to stand by our words. The fact that they've increased the auction sizes also should be a bit comforting.
Yeah, for the bond market, this is Santa came in early. This is everything that the bond market has asked of this governor has delivered. So, and I think Das is very clearly telling the markets that, I'm there with you. Ask what you want. I've already given you whatever you asked, and I'm here to support the government bond market borrowing. He actually mentioned the government bond borrowing program quite a few times. And he also made a very interesting comment. He said interest rate is a public good. We've not seen central bankers saying something like that. So I think this was a very, very significant policy. Just like that March policy where this was a bazooka, this is a bazooka again for the bond market. He's anchoring, and as Saugata said, he's pleading, he's moral suading. He also talked about the view part, right? Every view makes a market, and the view can be complementary to each other. So I think it's a very, very big guidance to the bond market. Bond yields should head down after this. The increase in size was something that the market has been asking, saying that 10,000 crores is not enough. So 20,000 crores of OMO, SDL OMO, which is, that means there's been some change in the regulation, or they must have taken a special dispensation to be able to buy state development loans. It will be very, very interesting how they do that. Too many state governments, which state government do they buy, which ISIN, but it's a very, very, it's a big message. And I found the TLTRO and the HTM very significant, because if you look at the 2010-11 scenario where rates plateaued below 5 and then very quickly went up, fiscal was one big reason, but another big reason was credit. So as credit growth picked up, bankers sold government bonds and yields went up. With the on-tap TLTRO and the HTM comfort till March 22, this is going to reduce the pressure. If at all credit growth picks up, this will reduce the pressure on banks you selling government bonds to be able to lend credit. There's enough liquidity and this TLTRO on an on-tap basis for specific sectors is going to be significant to ensure that even credit growth does not suffer. So all in all, a very, very significant policy for the bond markets.
Yeah, no, and I've dug up some of those quotes now that the governor's speech is uploaded. I must read them out because it is, I think, first of its kind that you've seen a governor say that financial market stability and the orderly evolution of the yield curve are public goods, and both market participants in the RBI have a shared responsibility in this regard. That's heavy burden on financial markets, I have to say. And then he does go on to say that, we look forward to the support. We look forward to cooperative solutions for the borrowing program for the second half of the year. Jaideep, as somebody who loves financial markets, first of its kind, we're not talking down to the markets. We're talking to the markets and hoping to take them along. Jaideep? Did Jaideep drop off? I think he did. Saugata sir, since you were alluding to those quotes, let me come back to you. Really, I mean, I don't think I've ever seen this before. We've always seen tug of wars between the RBI and the markets being broken by the RBI saying, hey, I'm king. This is a very different approach.
No, it is. I mean, obviously, I mean, the non-disruptive evolution of bond markets has been a constant motive, as you would have heard throughout. So Arvind knows. I mean, there were a couple of weeks when some unpredictability, some devolvements, etc., in the GSEC auctions actually spooked the markets a little bit. I mean, created some volatility in the market. So obviously, I mean, this is another signal that the past is past. I mean, bygones be bygones. I mean, we are in it together, and very very significantly. I mean, the increase in OMOs, the size of the OMOs. I know that the markets have been asking for this, what you mentioned. I mean, it's gone out of its way to make sure that both. I mean, everything. I mean, the interest rate motive, whether it be SLR securities, whether it be credit, whether it be actual flows of credit. So, I mean, obviously, they're very serious about spending money to get growth up.
How successful will the on-tap TLTROs be, Suvodeep, to your mind?
I think, see, the TLTRO will be as and when the banks get a comfort in terms of lending out. So I don't see it immediately as creating any kind of support right now. But I think as growth picks up, as certain sectors start to come out of the slump, and the credit pickup happens, I think that banks generally have to feel that they are comfortable lending out. Currently, they don't want a credit risk. They don't want a duration risk. I think that thing, once that kind of reduces, I think that they are going to be more positive. But I think the bigger point is not of the TLTRO or the HTM, but I think the SDL on the OMO side. I think the OMO SDL. I think that is something that I think the market would have silently prayed for since the start of the year,
Yeah.
or the start of the pandemic. And now that it has come through, and I think it gains importance because the banks are also going to be saddled with higher state government issuances in the second
Yeah.
half, especially if you look into the GST compensation part, the kind of
Right.
the solution that might emerge. I think that gains importance in the current context in the near term.
Okay, let me go to Jaideep. We lost him just when we were starting the conversation. Sorry, Jaideep. Okay, a bunch of questions coming your way. So first, of course, from your perspective, you're fairly confident that the financial conditions that it started to tighten will not. You think some of these TLTRO on tap facilities will see interest?
No, I think I'm not so terribly enthused with TLTRO because ultimately I think the risk appetite of the banking system has to come back, and I think that will take some more time. And I think it's not against. It still means you need excess government securities because TLTRO is against excess government securities. But I'm actually quite more enthused on the very direct comments around OMOs and SDL auctions, and I think the Reserve Bank did feel that there are risks on the long end of the curve in terms of rates, and to give comfort to market participants, I think this was a very very direct alluding to OMOs and whatever needs to be required to be done. I think that was far more interesting, and of course there are many other regulatory nudges that have happened to kind of give fillip to primarily focused on small businesses and smaller loans. So yeah, I mean, I think it's interesting that you can't do much on the rates front, but there is enough and more interesting ideas that the RBI has been throwing up over the last couple of policy measures in largely aiding credit flow to certain sectors. I mean, exporters also was an interesting twist. I mean, they're taking market feedback and trying to ensure that credit flow support that they can give, given the risk averse environment, is as much they can do. They are doing it.
Okay. Jaideep, your audio is not very clear, but I'm just going to try a couple of other questions which only you can help us answer. On the risk weight side, I'm a little confused about what entirely they've done. I don't know if you caught it clearly. So on home loans, they seem to be doing a graded risk weight based on the loan to value ratio. How was that different earlier? And then they also said something about a threshold of being raised from 5 to 7.5 crore in terms of the retail portfolio of banks for the assignment of a 75% risk weight. Did you catch those changes, and could you help us understand them?
Yeah, sure. Essentially, on the mortgages front, the risk weight of lower risk weights were available based on LTVs up to a certain threshold of the loan. For example, if your LTV is low and your total mortgage size is, let's say, below 75 lakhs or whatever that number was, then the benefit of risk weight was available. You could potentially have a 5 crore home and let's say a 2.5 crore loan, which is a very low LTV loan, and yet the risk weight benefit was not available because it was available only for small loans. I think what they have done is they have just taken the total quantum of loan out of the equation and just kept the LTV. So today you could have a 10 crore house and a 5 crore loan, and the risk weight will be quite low. So it's a fillip to essentially the urban markets in that sense.
You think that'll spur some amount of demand at this point in time?
Well, it is a nudge, definitely. It is a nudge. I think ultimately it also depends on the risk appetite that banks will have. Typically, banks have expressed better risk appetite on loans in the 30 to 75 lakh to a crore. I think big value, high value ticket loans, generally the risk appetite is low, but it does make a difference to, let's say, a 2 crore loan or a 3 crore loan in cities like Mumbai and Delhi, which did not have the benefit of a lower risk weight. So yes, on the margin, it will make a difference. Similarly, there is something called regulatory retail, where loans to small businesses up to 5 crores attract a lower risk weight of 75%. That threshold is now gone up to 7.5 crores. I think the 5 crore limit has been for many years. So anyway, simply by inflation, I think it made sense, and these are as good a time to kind of change some of these things. So that's also a nudge in the right direction to ensure that MSMEs, up to, let's say, 7.5 crore loan, get the benefit of a lower risk weight from a banking standpoint. Otherwise, from a risk weight standpoint, banks would focus on below 5 crore loans. So I think that is also something which is expanding the ambit of lower risk weights to a larger population of loans.
Okay. Deep, I'll say thank you to you. We are having some audio problems, but thank you
Sure.
so much for joining us briefly, and I'll go back to the rest of the panel. Arvind, let's talk SDLs. You mentioned it. I don't know whether there's a legislatory change required, but if one puts that aside, how does this start to play through the rates market? I mean, help us think through that.
So if you see over the last month, the on-off between the center and the state on GST compensation, and there was a mention that there'll be an RBI window which the states can tap into, had built-in uncertainty. You could see SDL spreads widening, the SDL yield cutoffs were rising, SDL borrowing, everybody knows, is going to be very high. And the SDL curve kind of anchors the AAA PSU curve also. So you have a GSEC curve, the 10-year and the 10-year SDL, and your 10-year PSU, 10-15-year PSU kind of ranges around the SDL levels. Also, the longer end of the bond market curve itself. So, for a SLR security, banks have a choice of holding government bonds or SDLs. So if SDLs are attractive at 70, 80 basis points, the longer end of the GSEC might not get the demand, or AAA PSUs might suffer. So there are a whole host of market factors that get implied because of SDL yields also. So this is very interesting. So historically, prior to Uday, SDL used to trade at 30, 40 basis points above GSEC. And over the last 5-7 years, you've seen that spread widening to almost 100 once and 100, 120, and now about 70, 80 basis points. So now that the RBI has announced OMO in SDLs also, we'll have to wait and see how they do it. Is it like a announced calendar it should reduce the spread premium that SDLs trade over GSEC, which should also benefit the longer end of the government bond curve. Because if you look at OMOs in government bonds, it doesn't happen in the longer end. It's typically in the 5-year, 10-year space, right? So and also the longer end of the corporate bond PSU. So that should get benefited. One thing I like to comment is that if you look at the priority itself, he spoke about growth first, which is the biggest priority, and then he gave a very nice comment that we will remain accommodative at least March 21, if or in FY22 as well. So that's a slightly longer, low for longer kind of Fed-like commitment. He's already done whatever it takes, the ECB kind of commitment, and then immediately went to financial markets. Inflation was this third point. So that's kind of details his priority in terms of growth, financial markets and financial stability, and then inflation. How that pans out is we'll have to wait and see. Food inflation in India is a very tricky thing. We saw that in 2009, 10, 11, how it kind of really had big problems with the RBI. But as of now, it's very, very clear: growth, financial markets, and then inflation.
Yeah, true. Saugata, do you agree with that? Although, I mean, technically, if there isn't going to be much in terms of rate easing, you can keep giving, a sort of an accommodative guidance. But, from an narrow MPC perspective, that probably doesn't change much, no?
Probably. Because remember, MPC's job is essentially the repo and the reverse repo. And obviously, I mean, at some point in time in FY22, the reverse repo lever will have to start working back up towards a normalization. That remains the thing. But from the SDL issue is I'm just waiting for the next expansion of his support. So you were asking that as of now they do not need any statutory change to do OMOs in SDL. They are allowed to do that. So I'm just wondering whether the next step, in case growth doesn't move up, is a more ECB-like measure to try to take on credit risk. Because even this time, remember, governor actually reiterated that other than the public interest rates being a public good, that lower GSEC yields actually on financial market instruments which are benchmarked to the GSEC, that also helps them. So that's another credit side. So that is another one. I'm sure they will not put that. They will need a legislative statutory change to take on any credit risk.
Sorry, your audio is breaking up a bit, Saugata, but you said there's no legislative change required for them to buy SDLs. On the RBI balance sheet, how will it show? Same as general government securities?
I would the Arvind would know this better. But to my sense, yes, I mean, as general government securities. I mean, there's no credit risk involved in SDLs. So because of an implicit guarantee, I mean, it's not laid down, but there's really no credit risk. So for that, they do not need a statutory change. It's there in the RBI.
So when they jump on this conversation, I think if you put it in the bigger picture and you sort of bring in the GST debate, etc., that's been going on right now, I think it's very clear that in the second half of the year, even if the central government maintains its borrowing, there is pressure on the state government side. And this is sort of, it fits into that. They'll figure out the modalities, I presume, on which states they buy from and what tenor they pick up. But it fits into the big picture.
Absolutely. I mean, I think even the RBI would be cognizant of the fact that if there is a limited window available from the, or a direct window available from the central government side in terms of compensating the states, there has to be a larger market borrowing in some sense from the states. Also, then you can tune probably the SDL OMOs to the, with respect to the states which actually would be borrowing more. Not all states would be requiring a huge borrowing increase, but that will probably be the guidance factor in terms of the RBI, how much they want to buy and from whom they want to buy. I think, at some level, you need to really, the comfort has to come from the RBI. Ultimately, it has to come from the RBI. It can't come from any of the state governments being fiscally responsible or anything. So this was a measure that was due. It has come in. And now it's up to the market to react to it, because this just lets the um, states be free in some sense in terms of borrowing, which is absolutely essential, especially in the second half.
I wish Jayesh Mehta, Bank of America, Merrill Lynch had been here, because I remember when there was this clamor for buying of corporate bonds, he had explained to me that the curve, the transition would go from central government bonds to state government bonds to support of CDs, bank CDs if required, and then corporate bonds. His point at that stage was that there's no justification to this clamor. Arvind, help us wrap up this conversation. I think the message that they have sent is that with uh, each policy or each month, they are staying on the curve of what is required for the economy and the financial markets. They upfronted the rate cuts. They've kept very, very surplus liquidity. They've continued with the LTROs, and now they're taking one step further at a time to ensure that wherever there is sign of dysfunction, to use the word, we will come in, because we will, as you said, our priority right now is growth and stable financial conditions.
Yeah, how many people expected them to do LTROs? And they did LTROs. They did twist, and now OM on HDL. So they've, as you said, they've been, I won't say reactive, but they are listening to the markets. They're saying, okay, this is a dysfunction, and I'm trying to address it. And today's was a very, very firm commitment, in the sense that he's almost openly telling markets that I'm there for you. I'm doing whatever you ask for. Till the time I'm accommodative, I can use all the tools that I have in my basket, and they've really expanded the toolkit. Uh, Expectations keep anchoring, right? So market keeps expecting more and more every time there is there is an impact. So we spoke about the DAS put. So the moment yields went above 6%, markets were expecting them to act, and they did act. So there is a DAS put in the markets, which is comforting for now. How things pan out, if things normalize, how do they normalize? Whether they take the reverse repo, they close down the band, all those kind of things, in terms of that will be the next market worry, but that's for some time later. Right now, I think they're very focused to ensure that they are not explicitly directly monetizing the government debt. So they're allowing the government borrowing to go in the market, and then supporting them with different things. I think the WMA thing also is important. I would have expected it to remain at 2 lakh crores, because that allows the government to just roll over excess borrowing into the next year without officially monetizing it. WMA is a kind of monetization, but they also have T-bills. I think that the government can actually roll over the T-bills that are outstanding, and then also, and so it might not be government dated borrowing. It could well be T-bills and WMA. So that is a comfort for the bond market. But having said that, the supply is still very, very high, and it will this belief in the RBI and the RBI's actions matching their beliefs has to continuously be there, so as to get bond yields down. Now, we can argue whether how much of the yield curve, how much of the longer end of the yield curve needs to be managed and brought down by the RBI. Their focus should be the 3-year and the 7-year curve, which is where the corporate bonds, the corporates borrow at that segment. And that segment has already got anchored because of reverse repo. With this accommodative into FY22, I think that kind of, if inflation does not surprise and it comes to that, I think they gave a 4% target for March 21, right? If it comes towards that level, I think they will remain accommodative till the time growth comes back to. Now, the aspect of growth is, we entered at 3%, 2% growth. So what is the normal growth in India? Is it 5, 5.5, 6? That's a big question that they will face next year.
All right. We'll leave it at that. Thank you so much indeed to all of you for joining us. Appreciate your analysis and your thoughts here. And I'll close off the programming with something we didn't mention, because it's not macro and it's not markets, but it's important. The RBI has announced round-the-clock RTGS. So the payment system in India continues to be world-class. We will have a lot more on that and every aspect of the policy on the website. So do go to BloombergQuint.com to read more. Thanks for watching.
Thank you.